Welcome to the market update. This is your instructor Scott C, and today is June 16th, 2024. Let's start by taking a quick look at what happened last week. And we're going to go to the Forex Factory calendar. And really, the big day was Wednesday. That's when we had the FOMC federal funds rate announcement. I'm going to go ahead and click on this little folder out to the right. And as expected, they kept the federal funds rate unchanged. If you go to this website, the CME FedWatch tool, they were predicting that the rates were going to remain unchanged. And check this out. The interest rate traders are currently projecting there's an 87.6% chance that they're going to keep rates unchanged again in next July. We know that the market is very sensitive about interest rates. And earlier, the Fed was saying that inflation is coming down. Wall Street was saying that inflation is coming down. They're going to cut interest rates. The Fed has still been saying that they expect 3 interest rate cuts between now and the end of the year. This is months ago. They were saying this at the beginning of April. 3 interest rate cuts between now and the end of the year. Everyone thought there wouldn't be a cut at the May meeting. Okay, everyone expected that. But you still had June, July, September, November, and December. That's 5 meetings. Now, the Fed doesn't meet every month. It's like every 6 or 7 weeks. But there's 8 meetings in a year. So you had 5 meetings between now and the end of the year. That's 3 rate cuts that they were saying was going to happen in these 5 meetings. All right, the market's kind of happy about that. But we've seen that inflation isn't coming down. So keep in mind that there's the pivot. Now, when is the Fed going to pivot from rate hikes to rate cuts? They stopped hiking rates in July of 2023. So yeah, that's true. They stopped raising them. They're just on hold for the time being. But they're not even close to a rate cut. But Wall Street started talking about this 2 years ago. It was the summer of 2022. Remember, the Fed started raising interest rates in March of 2022. And at the time, rates were 0. Now, when I say rates, we're talking about the Fed funds target rate. So it's a really short-term overnight rate. We're not talking about 5-year notes and 10-year notes. Those are different. But the overnight rate, they just started hiking in March 2022. They finished in July of 2023. So that's 15 months of rate hikes. And they got it up to where we're currently at, 5.5%. But Wall Street started talking about the pivot in the fall of 2022. Now, they didn't say it was going to be that month, but they said, early 2023, the Fed's going to cut rates. Well, then that turned into like mid-2023. And then it turned into late 2023, and then it turns into early 2024. Here we are in the middle of 2024, and they're still talking about it. But they've been wrong for almost 2 years. Now, we're not really expecting the Fed to raise rates, but you can't really take that off the table. Here's the issue is, are they really even close to cutting rates? Inflation peaked in June of 2022, right here at the very top of 9.1%. Now, a quick definition of inflation, it really isn't super complicated. When I talk about inflation, I'm talking about the Consumer Price Index, CPI, and that comes out monthly, and it's computed by the Bureau of Labor Statistics. It's measured on a year-over-year basis. So you look at the monthly index, and you say, what was it a year ago at that month? And then that's it. That's how they compute it. That peaked in June of 2022 at 9.1%. By the way, the highest since the early 1980s. So you go back over 40 years to find inflation that bad. By June of 2023, so a year later, it had come down to 3%. The Fed was putting up a mission accomplished banner. Well, you know what? It really wasn't mission accomplished. Yeah, 9.1% down to 3%. Great. Good job, Fed. But it wasn't the 2% that they're trying to get it to. So that extra little bit that they're trying to get it down to, the problem is they can't do that. And it's been going up ever since. So here we are, almost a year off of the low of 3% in June of 2023, and inflation is higher. It's higher than it was the prior month. So inflation isn't just stuck, it's actually been going up. All you have to do is go to Taco Bell or go to the market and you see that inflation is going up. So if you're the Federal Reserve, your job is to get inflation under control. And inflation has stopped coming down and it's starting to go back up. How in the world are you going to cut interest rates? Well, the answer is you're not. You can't do it. So Jerome Powell is like, well, we've seen some good data, but we need a little bit more confirmation. We're not quite there yet. They've been looking for this confirmation and they're not getting it. Inflation is still going up. And, really, why is it going up? Well, oil. Oil is a big issue. So when oil goes up, it filters through the whole supply chain, gas at the pump. And if you go to this website, AAA Gas Prices, really kind of a cool website, but they have their finger on the pulse of gas prices across the country. And they'll show like a nationwide average. They can break it down a whole bunch of different ways, but basically regular gasoline nationwide is, for the most part, going up. But it's not just gas at the gas pump. That's the most visible sign that we see. But the price of gas filters into everything you buy because everything involves transportation. If gas is going up, diesel is going up, everything moves by truck or train maybe, but mostly trucks. Everything you buy in the store, every loaf of bread, your canned goods, your fresh vegetables, whatever, it gets there by truck. And the trucks have to pay more for their diesel. They have to charge more for the freight, and then someone's going to have to raise the price of goods. So because of the transportation effect, because of that, the overall price of oil causes everything to go up. So that's just one of the drivers. It's not the only one, but it's just one of them. And how is that going to change in the short run? Two of the three biggest oil suppliers in the world are Russia and Saudi Arabia. The other one is the U.S. Well, we know what's going on with Russia and Saudi Arabia. They're actually cutting down on oil production. So if they're cutting down on their oil production, and you can see this news article right here saying that several OPEC producers extend voluntary crude supply cuts until basically the end of June. So how do you think that's going to affect oil prices in the short term and inflation? No small wonder that interest rate traders are expecting the rates to stay the same again in July. So even though the Fed held rates steady, they still indicated that there is going to be a cut coming this year, and I think you can see that the market was actually quite happy about that. So if you zoom in here on what happened last week, we're going to go just to these couple of days. Here's Friday, Thursday, and Wednesday. Look what happened between Tuesday and Wednesday. We got a nice jump upward. I think the market was still pleasantly surprised that a cut could be coming. Now, something that's really quite interesting that we didn't really expect was that France, not the Fed, injected some volatility into the market. So President Macron's gamble to dissolve the parliament and call a snap election to counter, I think it's Marine Le Pen's far-right surge, appears to be backfiring. Studies show that Macron's centrist alliance may lose its grip on parliament, with a hung parliament being the most likely outcome. So French markets have suffered. If you look at the CAC 40, which is a benchmark French stock market index. And this index represents a capitalization weighted measure of the 40 most significant stocks among the 100 largest market caps on the Euronext Paris index. So anyway, if you look at the CAC 40, it had its worst week in nearly a year, and bond yields are jumping. That shock may reveal that Europe's sovereign debt crisis wasn't really ever truly resolved, but it could also trigger a massive European Central Bank intervention, which could potentially boost risk assets. What that means is if they come in and they inject a lot of money, that money moves right into the stock market. So the S&P recovered near the end of the week, maybe in anticipation of that European Central Bank bailout. And that could support global stocks and provide a little bit of stability to the S&P 500. So really kind of a good week that we had last week. It was really interesting. But what's next? What can we expect next week? So going to the good old Forex factory, we see that there's really nothing big happening on Monday or Tuesday. Now Tuesday we've got this consumer confidence, and it's supposed to, according to the Forex factory platform, it's supposed to have high impact on the market. I'm really not going to pay much attention to that. You guys know that I don't really look at that as any kind of an indicator that's going to move the market much. Wednesday, we really don't have a whole lot going on. We've got the new home sales. We do have crude oil inventories, and we talked a little bit about how oil has a big impact on inflation. So the market could be looking at this instead of just kind of a minor impact. It might be a little bit heavier than what this website is indicating. Now, Thursday, we've got some good inflation data like unemployment claims, final GDP. And then also on Friday, we've got some items that could have a little bit higher impact on the market as well. So if you follow me pretty closely, you know that I like to look at a 2-week chart. It's basically a 14-day, in this case, really, you're just getting 10 days worth of data. It's a 30-minute chart, so each one of these candles is a 30-minute time frame, and it's a 10-50 simple moving average that we have on this chart. The 10 is this yellow, the 50 is this teal color. And it's a very simple system. The 10 crosses above the 50, we're bullish. The 10 crosses back down below the 50, we're bearish. Right now, this simple system that I like to use for short-term forecasts on the market is showing bullish on the SPX. Now I like to use the QQQ because it tends to be a little bit quicker, and you'll see that it's very bullish at this point. And until it crosses back below the 50, until the 10 crosses back down below the 50, I'm going to remain bullish on the market. But if we back up, we're going to look at the 1-year daily. We're pretty overextended, so don't be too surprised to see a pullback happen. No market goes straight up or straight down. But at the same time, even if we are expecting a pullback, or we know that one is a little bit more likely, right now, everything is indicating bullish, and you don't want to panic and pull everything out of the market because you think a short-term pullback might happen. Stick with the indicators because, hey, if more money is injected into the market, that filters right into stocks, and there's more upside, and you don't want to miss out on some potential gains. Right now, everybody's watching Nvidia. They just had their stock split. They've been on a tear. They're not showing any signs of a slowdown, but here's another stock that might be a bit overextended. Apple had a major breakout last week. If it can consolidate and pull back down to 200, broken resistance becomes new support. Could be a good one to keep an eye on. Bitcoin had a bit of a pullback last week, and you'll know that I'm still very bullish on Bitcoin. They had their halving back in April, and usually about a year after the halving is when it peaks after its run. So it hasn't really started running after that halving quite yet, but I think it's shaping up for a run sometime soon. And this pullback, to me, looks like a little bit of a gift. I'm still very bullish on Bitcoin. We talked about oil, and if you look at this strong run up, and then you can see a nice controlled pullback down to the 200-day moving average, Oil could be looking for a potential bounce at this point, and right now we're looking at XLE, the energy ETF. You could always look at individual companies like XOM, Exxon, from a high of 122-ish all the way back down to 110. Could be finding some support potentially. Might be a little too early to jump into a bullish trade at this point because we're just starting to break down below the 200-day moving average, which a lot of longer-term institutional investors do not like seeing. But watch for it to potentially consolidate, stabilize, and as it starts making its way back up, if it does that, it could be a potential longer-term buy near these levels. So whatever you decide to do this week, good luck and happy trading.